Economic Forum's annual summit here in Davos. And one of the talking points, not just this year, but for the last couple of years, has been the commodity super cycle. The other key issue I want to bring up with TV Narendran of Tata Steel is decarbonization, an important challenge that his industry is facing across the world. These are both talking points. And then, of course, we've had some negative news in India with regards to an export duty. So all of this is up for discussion right now over the next few minutes. Mr. Narendran, thank you very much for joining us.
Thank you, Menaka.
And we've had the luck of good weather here in
Absolutely.
Davos. Let me start by at least putting in context the conversations we're having here in Davos. It does seem as if most people continue to believe that we are in the midst of a commodity super cycle and that from here on prices will continue to rise. We haven't yet seen the peaks. Is that a correct assessment?
As I've always been saying, I think you'll see commodity prices higher than what we've been used to for the last 10 years. Okay. So it will fluctuate at a higher level because what's happening is the demand for a lot of commodities are increasing faster than the supply. I was in a conversation earlier where they said that the ESG transition is requiring more minerals and ESG itself is making sure mining minerals becomes difficult. So I think there are a lot of these complexities which will come on for over the next few years.
And do you expect that the rise in prices will be as rapid as we've seen happen over the last few years? Or that at some point in time, maybe 6, 12 or 14 months down the line, it will start to slow down?
I think it peaked soon after the pandemic when China recovered fast and the world announced investments in infrastructure, including India, right? Then it started settling when this Ukraine-Russia war happened. So I think there have been geopolitical events which has influenced the volatility much more than in the past. So it was again settling in, but I think the bigger concern we have, for instance, as steelmakers, is coking coal prices are still over $500. You know, it doesn't show any sign of coming down in a hurry. And that's of concern because that's a huge input cost for us.
Yes, you too are suffering input cost issues.
Absolutely.
Let me come to the news at hand. We just heard from the government with regards to the levy of an import duty. Of course, they've also, on the other hand, reduced some customs duties. But I think the big impact one will be the levy of the export duty, rather. Could you talk us through what the implications will be, and then I'll get into some more specifics?
Sure. I think we fully understand the compulsions.
Sure.
You know, with the pressure on inflation, RBI has had to act and the government has had to act, right? So to that extent, we appreciate the compulsions.
Yes.
It hurts us, but we appreciate the compulsions. Secondly, it creates a situation where obviously domestic prices will mirror international prices closer than it did in the past. Now, the key question is how long will this be there, this export duty? Because in the medium to long term, I believe India has a great opportunity to be a big exporter of steel. You know, because the countries who've traditionally been big exporters are China, Japan, Korea. They're all moving away from export markets, and rightly so. India has the raw materials. Russia and Ukraine, which have the raw materials like India, are also out of the export markets. So it's a 100 to 150 million ton opportunity for India as a potential steel exporter, which we should not miss because steel is produced in some of the poorest states in the country using minerals which are available in those states. So I'm okay in the short term to deal with inflationary concerns. But in the medium to long term, I think exports should be a very important part of a steel production strategy.
Sure, I understand that. And again, we get the government rationale, so not disputing that in any way. But when announcements of this nature come in, it becomes difficult for any industry to plan things like capacity, right?
Yeah.
Because you don't know what the life of something like this will be, when it will be taken off, will it get perpetuated? What immediate impact would it have for, let's say, capacity planning for companies like yours? For instance, I know you were planning to, hopeful of doubling capacity from the current 20 million tons, you know, now, and I think almost 10 to 15% of that was supposed to be for the export market.
That's right.
Are you rethinking that strategy?
So obviously what we are planning just now, the capex which is ongoing will continue because we are completing projects like the Kalinganagar expansion.
Correct.
So I think that doesn't get affected. The longer term planning will obviously depend on the longer term approach to exports because even when you look at 40 million tons of capacity, we assume 10 to 15% will be exported. So that's about 4-5 million tons. Now, if you're closing out export markets, then the question is you will pace your expansion as fast as the domestic demand grows. If domestic demand grows very strongly, good for us. If it doesn't, then we'll have to plan capacity expansion accordingly. But I hope that this export tax is more a short-term measure to deal with inflation and not a longer-term strategic call.
Okay. in the near term, and since you're going to, if you move some of this export material to the domestic market, what is the hit that you would take in terms of pricing? What were you expecting in the international markets? Because again, this depends on whether you're selling spot, contract. So I'm not clear on what the specific hit would be.
So I think just now there's a lot of panic in the market. Whether it's not just the steel companies, but the people in the value chain. Customers are not sure, should they buy now or should they wait for steel prices to drop further. So there's a little bit of a brain freeze going on, if I can say that.
Fair enough.
Yeah. So there's not much transaction happening just now. The price is trying to find its own level. It had anyway softened from the beginning of the month because honestly, when we started this quarter, we had expected coking coal prices to be over 600. It's at 510, 515, which is still too high, but lower than what we had thought.
Okay.
So steel prices were also settling to reflect lower coking coal prices than we had thought in March. So I think that finding that balance has got a bit disturbed because of this export tax. So we are still waiting to find that level at which transactions will happen
But
in India.
approximately where instinctively?
Well, I think it's already maybe 7,000 to 8,000 rupees lower than what it was last month this time. Okay. So
just within the span of few days.
Yeah, right? I mean, in the last few days, it's probably 2,000-3,000 rupees lower. But if I look at the last 2-3 weeks, because it's also reflecting international prices, coal prices, etc. Export tax only accelerated that journey. But at some point in time, we'll find a balance because honestly, the exports is also only about 10% or 15% of the volume. And for most steel companies, anyway, June volumes were not being exported much. So there's an impact in May exports. Where many steel companies are having to pay this 15% to customers overseas to honor contracts. But some of that volumes from June onwards will come back into the domestic market. So I think 7,000 to 8,000 rupees is what I'm seeing just now from what it was.
But if the real volume comes into the domestic market only in June, then that's when we start seeing even sharper hit to domestic prices.
Right? Well, the flip side is demand may come back because there was a concern.
In June, pre-monsoon?
No, because a lot of the demand, the feedback we had was demand was getting delayed because of high commodity prices. So if people have been postponing purchases saying commodity prices are high, then hopefully they'll come back when commodity prices are low.
So how do you sort of, how do you tell your investors what all of this is going to mean for the quarter?
We'll wait till the end of the quarter when we talk to the investors. But yes, investors get worried when they see this kind of fluctuation, and which is reflected in the share prices of all steel companies.
Any immediate capacity expansion that you're likely to shelve on account of this?
No.
Nothing immediate.
No.
Okay. Yeah. So what we're looking at as a worst case scenario, let's say for companies like yours, I'm sure you won't give me numbers, is sort of a bottom line hit for this particular quarter. Yeah. And then we'll see if the export tax continues into next subsequent quarters, right?
So I think the way I would put it is yes, it's a speed breaker on a journey. But I think there's also sometimes a feeling that, the sector is now going into a bad cycle. I don't think we are anywhere near that.
And the bottom line hit, Mr. Narendran, can't be more than 10 to 15% because that is the quantum of your exports, right?
No, but
so I can just do simple math on this.
No, I wish it was that simple. But the issue is what's happening is, while this is impacting directly 10 to 15%, it's impacting indirectly the balance 85%. The question that you asked, what are domestic pricing? Yeah, right. So I think that's where the impact is. But I think it will fluctuate a bit and then find its own level. Like I said, demand has got postponed. It will come back because fundamentals are still very strong. So if they're saying that infrastructure projects were put on hold because of high commodity prices, hopefully they will come back now. Right?
So that is the next question I wanted to ask you. Is demand everything that everyone had hoped for it to be? Because if it were that, then steel companies would not be so worried about putting most of the supply back into the domestic market. So on the one hand, we keep hearing, no, capex is picking up. More companies are putting up more greenfield facilities, not just brownfield or debottlenecking, and infrastructure is picking up. And then there's this concern that, if we pump so much steel into the market, and it's only 10 to 15% in terms of quantum, prices will dramatically fall. So I can't square the two.
Sure. I think the real issue is in steel industry, you add capacity in 3 million ton units. When you do an expansion, it's 3 to 5 million, right? So when you say demand grows at 7% a year, on a 100 million base, that's 7 million a year, right? But if each of us, JSW, us, JSPL, ArcelorMittal, all of us are adding capacity, we're going to add 3 million tons at least, each one of us, right? So the supply side is always ahead of, and not necessarily keeping pace with demand. That's why exports is important. So you will export so that because you have to run your capacities full to utilize the plants. So you will typically use exports as a buffer. For instance, soon after the pandemic, when demand in India was close to zero, we all exported 30-35% into China. And that's what kept the steel industry going. So exports is always a buffer, helps us manage the balance between demand and supply in the domestic market. So I think that balance should not get disturbed for longer than required.
In fact, you mentioned ArcelorMittal, and today they've said to us in an interview that they're going to reconsider their planned capital expenditure of 1 lakh crores over 10 years because they too are unsure whether this is, I guess the signaling is what's worrying most people. Not that the tax is being levied for a few months, but the fact that the government is using these tools, makes somebody worry, saying, where are we going to put this capacity to work?
I think the question for steel industry, should you plan your capacity expansion based on domestic demand or your ability to sell the product competitively to the rest of the world and in India?
So should you? Let me ask you that
I
question.
think we should, because I think
domestic, but can domestic demand support these fairly aggressive capacity expansions we're seeing, not just at your company, but at JSW and at ArcelorMittal Nippon, and the entire, next group of companies?
No, my point is India should be a big exporter of steel and we should allow for exports. I can understand the short-term pressures on inflation, but I don't think an export tax should be there permanently, because then we will miss an opportunity to build more capacity in India for exports. And if you're only servicing the domestic market, it's a missed opportunity.
Okay, fair enough. But you continue to have confidence in the demand scenario right now in India.
Yeah.
You're not seeing any slowing down either on account of very high raw material prices across the board or higher rates, interest rates. You're not seeing projects go under a rethink.
No, because I look at it this way. We were reasonably bullish about demand even before. Now, because of these actions, prices are coming down. If there has been a delay in projects because of high prices, then hopefully they'll come back and demand should look better. That's the way I look at it.
Okay.
Yeah.
I've exhausted the irony of talking about India export tax in Davos. What I did really want to talk to you in detail about, and I guess, at least let me put a few questions to you, is the challenge of the decarbonization of the steel industry. And I think that is really the more interesting conversation across players across the world. Where is Tata Steel in that process? Where is the Indian steel industry in that process? Can you give me a sense?
Sure.
Yeah.
No, I think it's an extremely important journey for the steel industry going ahead and also for Tata Steel. We've already announced plans in Europe because Europe as a geography is ahead of the rest of the world in planning for it, planning the infrastructure, planning the policies, etc. So each country has set its own goals, and we've said that we'll move into from coal-based to gas-based to hydrogen-based steel making in Netherlands, for instance. In UK, the opportunity is about leveraging the scrap that is available in the UK to make steel which has a lower carbon footprint. In India, it's going to be even more complex because, firstly, in India, if you have to move from coal to gas to hydrogen, you need to have gas available in Eastern India, right? Today, there's no gas available in Eastern India, and I think we need to work with the government to see how soon can gas be available in Eastern India. Otherwise, steel companies and most of the capacity is being added in the east because iron ore is there.
Right.
Will keep investing in blast furnaces, and if you invest in a blast furnace, you're going to run it for 20 years or 40 years, right? So I think that's a call we need to take. It's a very important journey, but the cost and complexity should not be underestimated. I think Europe is realizing that, right?
I was just going to bring up that in Europe we're already seeing this play out. Right?
Absolutely, because Europe had assumed that they will transition easily from coal to gas, but now with the problems with Russia, many countries in Europe were dependent on Russia for gas.
Yes.
So they don't have the LNG network to import gas from other parts of the world. Norway, which is a gas producer, is trying to maximize the gas production but cannot substitute for Russia. So I think these are, big place, because over the last 100 years, we built the infrastructure for fossil fuels, right? Coal can move easily. If you don't get coal in Russia, you'll buy from Australia or from North America, wherever. But the gas infrastructure, LNG network, gas pipelines, and we are not even started talking about hydrogen.
Yeah.
So all this needs to be built for the world and for the steel industry to transition to green. So I think it's a great challenge, great opportunity. Also, a lot of innovation will need to come in because it's not a silver bullet which will solve the problem. There'll be a bouquet of solutions which will have to be used.
The European business has already started working on plans to become, let's say, next generation ready in that sense.
Absolutely. So in Europe, we had already announced that we'll be net zero by 2050. But now, as a group, we've taken a call, Tata Steel, that we're going to chase net zero by 2045. So
Okay.
that's something that we have.
And does that require large capital investment?
So more than capital investment, yes, it will require for a lot more use of scaling up of technologies that are available today. So we're already doing a lot of work both in Europe and in India. For instance, we set up in India India's first carbon capture and usage plant in a steel company in Jamshedpur. We're setting up a biomass-based hydrogen production unit in Kalinganagar pilot plants. But all that needs to get scaled up in a very big way. In Europe, we had already done work on Hisarna, which emits the kind of carbon which is easier to capture and store. We made the plans to transition from blast furnace route to a gas-based DRI route to a hydrogen route. But we are talking to the Dutch government to see when can gas and hydrogen be available and at what price. So once we have clarity on that, we can move ahead with our plans.
Okay.
Yeah.
Is there any immediate impact on your operations as a result of the energy crisis that some parts of Europe are facing, either directly or indirectly through your customers?
Directly, we were quite well hedged on gas prices when gas prices shot up. And I think gas prices are settling down now.
Okay.
So to that extent, I think the worst is behind us. Our customers, particularly auto customers, have been impacted by the
Because I'm hearing of
neon
shutdowns.
gas, neon gas issues from Ukraine. So the auto pickup has been a bit slower than what we had anticipated. But other sectors have been reasonably strong. Uh, so I think so far, what has been impacted on the demand side has been offset by supply constraints because Ukraine and Russia are out of the EU
Correct.
market,
Okay.
and now India is also out of the EU market. So that creates a situation where the spreads in Europe can continue to be reasonably healthy for us.
So you feel confident about
Yeah.
growth in Europe, lower than growth in India,
Yeah,
but still
if
steady.
not growth, at least not the
Steady
kind of
state.
yeah. Europe
If
is a
not
mature
growth,
market.
you're saying? So
No,
not
because
even the 2 or 3% growth that you were
I mean,
initially planning?
I mean, just now we stand by that, but I think there are forecasts that the war continues for very long. Europe may go into a recession.
Got
I'm
it.
more commenting on that. Just
Sure.
now, it's fine. Yeah.
All right. Okay, great. I think that pretty much wraps it up for me. I just one last question, if we may do, which is on. I think you said somewhere that you don't intend to do any more inorganic acquisitions. Is that correct?
So what I said
You're
is,
taking yourself out of the marketplace.
no, we always reserve the right to exercise that option, right?
Okay.
So we don't want our competitors to have it easy. But I think the point you're making is after Nilachal, we now have 3 sites in India, which can help us to grow to 45, 50 million tons with existing sites. We don't need any new sites to more than double our capacity in India. So we will look at it if we need to participate in it, but we are not under any compulsion or we are not under any
You
pressure.
never were under any compulsion.
Well,
There was one moment, I think, when you were playing catch up.
No, that was
for
one.
having taken your eye off India and focused
Possibly,
on Europe a
but
little bit
I think
more.
what we were missing was long products in our portfolio.
Okay.
With Nilachal, that has got addressed.
So you don't need,
Absolutely.
you don't have any gaps to fill.
Absolutely.
With regards to
Absolutely.
acquisition.
We had already said earlier that we were not going to participate in any flat products in organic opportunities.
Sure.
Because we have enough. And long products was a gap, which has also got plugged.
All right, Ms. Narendran.
Okay.
Thank you so much
Thanks,
for your time.
Thank you.
Thanks
Thank you,
very
Menaka.
much.
Thanks.
Thank you.